So, as we're gearing up for 2023, looking forward to 2024, there's something on all of our minds: taxes. Now, don't click away just yet. I promise to make this as painless and helpful as possible. So today we're going to be navigating the twists and turns of year-end tax planning and hopefully set ourselves up for success as we enter the new year. So grab your notepad and let's get into it. So first on our list, Roth Conversions. So you might be wondering, what is that? Is it even relevant for me? So here's the deal. Understanding Roth Conversions can potentially be a game changer. So let's break it down real quick. Imagine it's December, it's the end of the year, and you're looking at your earnings throughout this year. Maybe you had some unexpected expenses, or perhaps this year you just didn't do as well as you had hoped. So this could be a golden opportunity for Roth conversion, especially if you're in retirement. Why is this? Because converting your income in a lower tax bracket means paying less tax now on that conversion than potentially down the road. But it's not just about this year. The money in your Roth can grow tax-free and come out tax-free in retirement. It's like planting and paying the taxes on a seed today and enjoying the fruits of that tax-free tree down the road. And here's a pro tip. Keep an eye on the Inflation Reduction Act. It brought in some changes this year that could affect your decision whether or not to convert. So talk to your tax advisor. Make sure you're making the best move, not only for today, but also for your future. Next up, we're going to talk about 529 plans, salary deferrals, and gifts. So if you have kids and you're planning for their education, a 529 plan is something you should be looking at for sure. These type of plans offer tax-free growth and withdrawals for qualified education expenses down the road. And if it's a state-sponsored plan, you could even get a write-off on your state taxes. For example, we have the MESP 529 plan here in Michigan. And with the end of the year approaching, now is also the time to make those contributions so you can get that write-off. But it's not just about education savings. Maximizing your retirement plan contributions can significantly reduce your taxable income. So ask yourself, am I contributing enough to my 401k, 403b, and IRA? Remember, these type of contributions need to be sorted out before the end of the year. And let's not forget about gifts. The annual gift tax exclusion can be a powerful tool as well. Basically, you can give up to a certain amount each year to a recipient without eating into your lifetime estate in gift tax exemption. So you also want to consider that as part of your year-end tax strategy as well. So let's shift gears here to something a little bit more advanced: tax loss and tax gain harvesting. This is like playing a game of chess with your investments. The idea is to sell investments at a loss to offset capital gains. It's a strategy that can help reduce your tax bill. For example, let's say you have some paper losses of $10,000 this year. Now, if you go in and lock in those losses before December 31st, you can use $3,000 to offset your ordinary income. $7,000 rolls forward to next year, but that $3,000 this year, if you're in a tax bracket of 25% for easy math, that'd save you about $750 in taxes. But here's where it gets interesting. Have you ever heard of tax gain harvesting? This is especially useful if you're in the 0% long-term capital gains bracket. You can actually sell your investments at a gain without having to pay any tax. It's like getting a free step up in basis. Essentially, pulling gains forward into this year could allow you to sell an appreciated asset for free. And for the crypto enthusiasts watching, yes, this even applies to your digital assets too. Just remember that the wash sale rule can be your enemy here. It essentially prevents you from repurchasing the same or substantially identical asset within 30 days before or after the sale. So something to be aware of there. Now let's address something a little bit more mundane here, not exciting, but still incredibly important: estimated taxes and withholdings through work. So you might have multiple income streams, or perhaps you're even juggling between being an employee and being a contractor with some 1099 or some self-employment income. This can definitely make your tax situation a bit more complex. So the IRS, they've got a handy tool for checking your estimated taxes and your withholdings throughout the year. Why is this important? Well, if you have significant credit reductions or dependents over 17, or even if your income fluctuates, you need to be on top of this. It's all about avoiding surprises come tax time. So you do all this work and you figure out you're falling short. there's still time to adjust. You can make additional payments, or you could even tweak your withholdings in these last couple weeks of this year. It's like fine-tuning your tax strategy to ensure that you're not left with a hefty bill and potential penalties in April. So as we wrap up this quick video, remember this: planning now can potentially save you headaches and money later. Review your coverages, review your contributions and your withholdings. Just take a second to look at those home office deductions as well, especially in these times when many of us are now working remotely. And most importantly, if you're feeling overwhelmed, reach out to a tax professional. They can help navigate these waters with you. Thank you so much for joining me today. If you found this helpful, please like, share, subscribe for more financial insights. Don't hesitate to drop your questions or experiences in the comments below. Until next time, stay on point. I'll talk to y'all soon. Once again, I'm Ben Barnhart, and I'm the founder of On Point CRNA and Barnhart Wealth Management. If you're interested in learning how we help our clients across the country with their money, head over to www.onpointcrna.com.